Every country in the world borrows money to some degree. Some countries have strong economies and they can keep borrowing for decades, like the United States, and other countries, they push it too far, like Greece or Argentina, and eventually they wake up and realize nobody wants to lend them money anymore. And once you start to see that happen, you start seeing people losing their jobs, massive protests pushing for regime change, and the currency collapsing. And to really understand how countries get there, we have to start with what debt actually is. Debt is essentially a promise to deliver money in the future. When a government borrows, it's promising to pay that money back with interest. And a debt crisis happens when there are more promises made than there is money to deliver. For a country to function long term, debt can't grow faster than the economy that's supposed to support it. If debt keeps rising but income doesn't, eventually the math breaks. You hit a point where you're spending so much just on interest payments that you can't fund essential government services, and investors stop believing you'll pay them back, so they stop buying your country's bonds. This is when you start to see the central banks step in and they'll start printing money just to keep the system functioning. And when those things start happening together, you're in a debt crisis. And what happens next depends on one critical detail: whether your debt is in your own currency or someone else's. If your debt is denominated in your own currency, like the US or Japan or the UK, your central bank can print money to pay it off. That doesn't mean there are no consequences. Printing money devalues the currency, it creates inflation, it destroys savings, but it prevents a default on the debt and it buys you time. If your debt is in someone else's country, like Greece borrowing in euros or Argentina borrowing in US dollars, you don't have that option. You can't print euros and you can't print dollars. So now you're stuck with three choices and none of them are good. Option one, you can default. You can tell your creditors you're not paying them back. If you pick this option, you will get locked out of international borrowing markets and your economy will collapse. Option two, you try to restructure. You negotiate with your creditors to reduce the amount you owe, you try to extend payment timelines, or you lower interest rates, and it still hurts your economy, but not as severely as defaulting. And option three is austerity. That basically means the federal government runs a tight monetary policy. They basically slash government spending, they raise taxes, and they try to pay back the debt. Your economy shrinkens, unemployment will spike, and people start to riot because of all the cuts on government programs and funding. And this is a very unpopular political opinion, but it does work. But honestly, most countries end up doing some combination of all three. If you look at Greece in 2009, they were running a budget deficit of almost 16% of GDP. Within months, borrowing costs exploded towards 10%, and investors stopped lending money. The country was effectively cut off. So Greece needed a bailout, and they got it. In total, they got 110 billion euros from the European Union and the IMF. But that money came with strings attached. The IMF forced Greece into one of the harshest austerity programs Europe has ever seen. There was massive spending cuts, higher taxes, wage freezes, pension reforms, and state companies were sold off, and Greece complied. On paper, it worked. The deficit dropped from 16% to 6.6% by 2012, and eventually they balanced the budget. But in the real world, it was devastating. Unemployment hit 27%, youth unemployment reached 60%, and the economy shrank by 25%, even worse than the US during the Great Depression. And even after all of that sacrifice, Greece still couldn't pay its debts. So in 2012, they restructured and private bondholders took losses and 107 billion euros in debt was wiped out, the largest sovereign debt restructuring in history. By 2015, Greece became the first advanced economy ever to miss payments to the IMF. They eventually needed a second bailout, they needed more federal tightening, more pain, and during this period, 20 out of 26 countries that received IMF loans saw mass protests or strikes. Now let's look at what happens when a country does have its own currency and they decide to print their way out. Look at Zimbabwe from 2007 to 2009. Government spending was way higher than tax revenue, so instead of cutting spending or restructuring debt, they printed money to cover the gap. At first, it seemed like it was working. Then prices started rising, and by November 2008, inflation hit 79 billion percent per month. Not per year, per month. People were getting paid and rushing straight to the store before prices changed an hour later. A loaf of bread cost millions, then billions, then trillions. Savings were wiped out, salaries became meaningless, and the currency completely collapsed. Eventually, Zimbabwe gave up on its own money entirely, and they started using the US dollar instead. That's what happens when printing replaces discipline. You avoid default, but you destroy the currency. And I know a lot of you guys recently have been hearing about Japan's debt crisis right now. So let's break it down. Japan's debt to GDP ratio is over 250%, the highest in the developed world. By every normal rule, Japan should have collapsed decades ago, but it hasn't for a few reasons. First, the debt is in yen, Japan's own currency. That means the government of Japan can step in and buy government bonds whenever it needs to. Second, Japanese citizens save a lot and they buy a lot of their own government's debt. So most of Japan's debt is actually owned domestically, not by foreign investors who can panic and pull out overnight. And third, this is really important, Japan runs a current account surplus. Basically, they export more than they import, which means foreign currency keeps flowing in and strengthening the dollar. And fourth, the yen is considered a safe haven. When global crises hit, investors actually buy yen instead of dumping it. And fifth, Japan doesn't even have inflation, they have deflation. Their problem isn't too much spending, it's not enough. So Japan can carry debt levels that would completely destroy most countries, but it's not free. They can't do this forever. Economic growth in Japan has basically been flat for 30 years, and their population is aging and their workforce is shrinking. And their debt service costs keep rising. And according to Dalio, who studied 35 major debt crises across history, Japan is now closest to its limit than it's ever been, and there may be a major collapse soon because the economy is not productive enough to carry on with these debt levels, and all of this debt is fueling a major financial bubble. Now let's zoom out for a second and talk about Dalio's framework. He's a very successful hedge fund manager who's studied 35 major debt crises across history and found that they all follow a typical pattern. First, roughly every 80 years, about one human lifetime, the people who lived through the last debt crisis, they remember how painful it was. So they're very careful. They purposefully don't take on crazy amounts of debt. But by the time their grandchildren are running things, the memory is gone. So borrowing ramps back up, leverage increases, asset bubbles form, and everyone assumes that things will keep going higher and the cycle starts to repeat. And Dalio breaks this cycle into 9 stages. The first 4 are private sector driven. Basically, businesses and households, they borrow too much, asset prices inflate, defaults start, then the government steps in and borrows heavily to stabilize everything. That's basically what happened in 2008. Then stages 5 and 6 are where it spreads to the government and the central bank. Now the government itself has too much debt and private investors, they stop buying government bonds, so the central bank steps in and they start printing money to buy that debt. That's where we are right now. We're in stage 5. And just to put some numbers on it, the Federal Reserve balance sheet went from under 1 trillion before 2008 to almost 9 trillion at its peak. And stages 7 through 9 are the reset. Debt has to come down somehow, either through defaults, through restructuring, or through money printing and inflation. And eventually you reach a new equilibrium, and the whole process starts all over again. Dalio says we're in stage 5 today, and once you reach that point, you typically have about 2 or 3 years before things start getting critical. And he points to 3 warning signs. First, interest payments start crowding out everything else. In 2025, we've spent over $1 trillion on interest payments. That's more than we spent on defense or Medicare in a single year. Second, governments start issuing more bonds than investors want to buy. And you start to see rates on debt start to rise. And if you look at our situation right now, foreign ownership of US treasuries has fallen from about 50% to 30%. And third, the central bank becomes the buyer of all the newly issued government debt, which the Fed is basically doing right now. And right now in America, all three are basically happening at the same time, and that's how you kind of know where we are in the cycle. Look, the truth is, governments don't deal with debt the way regular people do. If you max out your credit cards and you take on a bunch of debt, you have to face it eventually. Politicians don't. Their biggest incentive isn't solving long-term debt problems, it's getting reelected. So instead of dealing with debt today, they can push it forward. They can kick the can and they'll say, we'll let the next administration handle it. So they'll promise benefits now and they'll worry about paying for them later. That's how you end up with massive deficits, exploding interest payments, and obligations nobody wants to talk about. But America has something that most countries don't. We have a culture that rewards building things, it rewards starting businesses, taking risks, creating value, innovation. That's very powerful. And it's kind of the biggest reason that the US keeps growing even when the numbers don't look that good. It's why we still attract talent and capital from all over the world, and it's why the system hasn't broken yet. And that's the real point of this video. It's not to say that everything is doomed, but to understand what's actually happening behind the scenes. Because at the end of the day, governments don't magically fix debt problems. People do, voters do, entrepreneurs do, informed citizens do. So when you understand how this system works, it's harder for politicians to sell you easy stories and empty promises, and it allows you to be more informed for your financial future.